All right, we'll go ahead and get started here. First of all, quiz last week. Anybody have any questions on the extra attempt that I added? I moved the due date of the first quiz to a week from this past Sunday, so this upcoming Sunday is the first actual hard due date. So Chapter 9 quiz and Chapter 10 quiz are both due this coming Sunday. I did that so that I could add a third attempt, which I added, and I changed it in addition to that to when you click next attempt, from now on you should only see questions you missed. So if you got all but one of them right on your second attempt, you will only see the one that you missed. And you will only have to get that one right to then get 100% on the quiz. Anybody have any questions on that? Yes, sir.
You said you already put the quiz up?
So for Chapter 9, I think I did it. So Chapter 9 should be due date showing this coming Sunday, and then also another attempt if you've already exhausted your 2. Any questions on that? Everybody with me? You're welcome to come up here or stay back there. It's up to you. You're fine? I brushed my teeth this morning, I swear. Now, you don't have to come up here. You can stay back there if you want. All right, any questions before I move on? Once again, let me reiterate, you have to buy Connect to pass the class. That's all of your points will be in there, except for the 1% that I'm just giving away extra. Okay? Have to buy it. All right, so today we're going to talk plant assets and, well, basically just plant assets. Natural resources are talked a little bit in this chapter in the book. I won't cover or spend too much time on them in class. Intangibles we'll cover, maybe we'll get to today. If not, we'll cover those on Thursday. And then on Thursday, we will also walk through examples. The main thing we're going to talk about today with respect to plant assets is depreciation. But first, let's just talk about what plant assets are in general. So these are going to be generally when you think long-term assets for a company, this is what you're talking about, plant assets. Also known as property, plant, and equipment. Those terms are used interchangeably in the accounting world. And fixed assets also is another term that's sometimes used to mean either property, plant, and equipment or plant assets. Yes, ma'am? It's not up yet, but I will put it up. You wanted to take notes on? Let me put it up right now then. Give me just a second. I should have done that before class, but it won't take me but just a second here. Might take longer than that if I'm not connected to the internet. Do you care what format's it in? PowerPoint's fine. All right. It's under Files in Canvas if you want to look at the PowerPoint here. back to the story here. Plant assets. So these are going to be your long-term assets for a company. So think items, when we say long-term, it's going to be anything that lasts longer than a year and is providing benefit to your business for that time period. This is not inventory, and this is not anything that will either be used up or turned into cash within the next year. So typically this is all of your, like if you have a factory, your factory equipment, your buildings, vehicles, anything that meets all of those categories, okay? Why do we care what goes into the category of a plant asset? Well, for one thing, we distinguish between current and long-term assets, so that's one important reason. The other thing is only those types of assets that go into this category are the ones that we depreciate. Okay, so we're mainly talking about this so we can get into a discussion on depreciation. Now, without thinking of, if you've already read the chapter, I don't want you to say what you've learned in the chapter or anything related to accounting, but just in general, when I say the word depreciate, what does that mean to you all in layman's terms? In plain English, what does that mean? Yeah, okay, everybody knows that, right? Just in your life, you know that depreciate just means it goes down in value, right? But in accounting, the term depreciation is not just, hey, this is going down in value. So think in accounting terminology, depreciation has its very own meaning. Okay? This picture that you see here is kind of showing what happens with most assets in terms of their market value, which is what you all just talked to me about. Market value is how much can you get in the market for this item. And over time, you see the building there, it starts to fall apart and degenerate. And so over time, the amount that you could actually get in the marketplace for this building, as time passes, that usually goes down, right? So over time, value goes down in the market, and also on your books, the book value of an asset goes down over time as well. So we will talk about market value on one hand and book value on the other. Book value has to do with accounting depreciation. Market value has to do with actual depreciation in real world value. Okay? Those are two different concepts. So whenever I say market value, you should think of in terms of what can I get in the market for this. Whenever I say book value, you should only be thinking in terms of what is the value according to depreciation of this asset on my books. Okay? We'll talk about that more in a second. But for right now, when we talk about any of these assets, there are three different time periods that are relevant to us here. The point of acquisition, the useful life of the asset, and then the point when we dispose of the asset. As far as accounting goes, these are important time periods because there's going to be a journal entry that happens when we acquire the asset. There will be journal entries that need to be made over the life of the asset, depending on if we're just allocating value over time periods. And then also, maybe we have to do some extensive repairs to this building. And so during the life of the asset, there may be some journal entries that happen. And then when we get rid of the asset at the end of its useful life, there will be a journal entry associated with that as well. So during its useful life, those journal entries, that's where depreciation comes up. Okay, accounting depreciation. But first, going back to these three time periods, the first thing we need to figure out is how much cost goes into this acquisition point. How much dollar value do I record within the actual asset category that we're talking about? So it's easier to look at if we look at a specific category of assets. So you've got machinery and equipment. For a business, you may have an account called machinery and equipment. Okay? When you're buying machinery and equipment, not only does the initial purchase price go into that account, but also all of these other items that are necessary to bring the asset to its whatever condition it needs to be in to be used. So in this case, we needed insurance to get it here. We had to pay to get it here. There were taxes involved. Then there was this installing, assembling, and testing. In accounting terms, all of these things basically are just a component of the overall cost of this item. So just like the purchase price is a component, so is installing, assembling, and testing. What does that mean? If we were doing a journal entry for buying some machinery and equipment, we would have a debit to machinery and equipment, and a credit to cash, or if we were paying with accounts payable or whatever. So that would be my journal entry for the initial cost of my machinery and equipment. All of it. Insurance, transportation, taxes, purchase price. Those are all captured within the debit, machinery, and equipment. And all that's telling us is, when we buy these, we're changing one asset, cash, so the cash account's going down, for another asset called machinery and equipment, and that asset account is going up by the amount that altogether this cost us. Okay? Everybody with me? All right. So that's for machinery and equipment, and it has all of those extras that go with it. Then we also have another category within this property, plant, and equipment. And incidentally, none of these account titles are necessarily going to be uniform no matter where you go. So this may be called buildings one place. It may be called warehouses, if that's all you have, another place. It doesn't really matter the title of this, as long as you know, okay, there's going to be some asset account within the property, plant, and equipment that's capturing where my buildings are. Within that account, the attorney's fees, taxes, brokerage fees, and the cost of the initial purchase or construction, and the title fees would all go into the journal entry that said debit to account called buildings, credits to cash or accounts payable or whatever. Okay? So again, following the cost principle of accounting, all of the costs associated with bringing that asset to its usable condition go into that initial journal entry. And incidentally, if you were, you may at some point want to know how much you paid in attorney's fees, taxes, brokerage fees, etc., or the breakdown of how these costs were expense, or I shouldn't say expense, the breakdown of how these costs were accumulated. And if you did, where you would probably find that is in the notes to the journal entry. Okay? So typically the notes to the journal entry would just be like 3 words that said, hey, this is a journal entry to record cost of purchasing this building. But in cases like this where there might be relevant, okay, this is broken down by X amount of title fees, attorney fees, brokerage fees, taxes, and the initial construction, that might be something that you put either in a subsidiary ledger or as just a comment within this journal entry. Okay? But that would be the initial journal entry. Then we have another asset category that's within this property, plant, and equipment called land. Land is special because we don't depreciate land. No, we haven't talked a lot about the nature of how depreciation works or anything, but when we talk about land as a class of assets, it's important to note that we don't depreciate. What does that mean? Well, at the initial purchase, or the time of purchase, I should say, of the land, you don't do anything different. Okay? You still are going to have, just like we did with machinery and equipment or buildings, you're still in here going to have a debit to land and a credit to cash. Okay? That's format-wise, that looks just like the other journal entries did. Because that's just recording the initial cost. Later, when we started to do depreciation on the assets, then it would change between land and the types of assets that actually get depreciated. But when we're just worried about the initial cost, again, we're going to capture all of these fees and such that go to getting the land to its usable condition. This doesn't mean actually like going out and like plowing the land, that type of thing. We'll get to that in a second here. But this is just getting the land able to be usable in terms of, okay, I'm legally able to use this land now. Okay, so because of that, we have another asset. Because of the fact that land doesn't get depreciated, we have another asset category called land improvement. Okay, so if I have a piece of land that has a bunch of stuff on it, not buildings, obviously buildings would be a type of land improvement, but example I used in my last class, I just got back from over break taking my kids to Disney World. Okay, anybody been to Disney World? Okay, how many parking lots do you see there? Size-wise, does that make up a lot of land in the Disney World? Yes, it does. Okay, and I went. It was pretty not busy, but there still seemed like there was more parking lot by far than actual park. Well, parking lots are an example of land improvement. So the underlying land that the parking lot is on, we say that we don't depreciate the land itself because we say generally land doesn't change in nature. So if I ask you, or I went to Disney and I said, okay, the land this parking lot is on, 30 years from now, is that going to change in its nature such that it will no longer be of value to you as a parking lot? No. Okay? Land, theoretically, unless there's some catastrophic event, land 100 or 200 or 500 years from now is going to be just as useful for a parking lot, theoretically. Obviously, I don't know how much that land will change, but in terms of a lifespan of a human, land pretty much stays the same in terms of its useful life or the things you're able to do with it. Now, I will say, since this chapter talks about natural resources are a separate issue from the land that you would find in. Okay? So there is a separate treatment, separate concepts involved when we talk about natural resources. Obviously, if you're worried about pulling the oil out from the land, 20 years from now, after you've taken all the oil out, the land is a lot different than it used to be in terms of value that you get from oil. So that's kind of a total different animal. In terms of land improvements, like I said before, this is very similar to how buildings work. Buildings is just a very specific land improvement category. Okay? So again, everything that would go into getting these parking lots ready to use or whatever, driveways, fences, etc., all of the costs associated with that would go into the initial cost of that. And again, this should look very familiar now, but you would have a debit to land improvements, or whatever your business called that account, a credit to cash, and that would be the journal entry that captured all of the initial cost of these assets. Okay, so that leaves us with a bit of an issue that sometimes comes up. We'll talk more about this on Thursday, but sometimes you will get, and actually more often than not, when you buy a piece of property that has a building on it, you will actually be purchasing several, usually 3 different types of asset class with one purchase. Now, that's not really a problem other than the fact that most of the time when you make the purchase, the people you're buying from have not gone out and separated the value of the land improvements, and the building into 3 different categories. So this is an example of a $90,000 purchase. And all that we see when we make the initial purchase is $90,000 left our pocket, and what we now have is a piece of land, some land improvements, and a building. Once we have that, we need to go in and allocate some portion of that overall $90,000 cost to each of those categories because we handle their depreciation in different ways. That's why we need to separate it out. And actually, land improvements and buildings not as important to have those separate as it is to have the land improvements and building be separate from the land itself. Why? Because the land will not be depreciated, everything else will. And then also it's helpful to have these distinguished, land improvements and building, because they will be different asset classes and likely have different useful lives. So again, important to distinguish. So how do we do that? How do we break up when they have not divided this out for us, but we need to go in and assign value to each of these portions? Well, all we have to do, we go out and generally when accounting says to go out on the marketplace and find the value of these, when we try to find a value, we either need to have some assessor, some professional come out and give us a value, or if whatever we're looking for the value of, if there's an identical item of those on the marketplace, we can use the marketplace value. In this case, we would have to have someone come out, look at the property, and give us an appraised value of it. So we say, we had someone come out, they said, okay, the land's worth $30,000, the improvements are worth $10,000, and the building's worth $60,000, for a total of $100,000. $100,000 is more than what we paid for the property. Okay, that doesn't matter. The appraisal, the only reason we care about that is we want to know what percentage of the total value should be assigned to each of those categories. So we go get an appraisal, it gives us a total value, and it has that total broken up into the 3 categories. So if we take each category, so I take the $30,000 assigned to land, if I divide that by the total appraised value, it gives me a percentage. So the land makes up 30% of my overall value. Okay? Improvements make up 10%, and then the building makes up 60%. Once I have those percentages, remember I got those based on the appraised value, not the actual value that I paid. I take the percentages based on the appraised value, and I multiply each percentage times the actual amount I paid. So 30% times the 90,000, 10% times the 90,000, 60% times the 90,000. That gives me the allocation of each asset class. 60% times 90,000 gives me 54,000, which means 54 of the initial 90,000 is allocated to buildings. 9,000 is allocated of this 90,000 is allocated to land improvements, and 27,000 of the 90,000 is allocated to land. And I know that's a little mathy, but is everybody more or less with me on how I got that? There will be very few times that I ask you to actually do this, but it is at least you should have in your mind the way that is done. Okay? And it's pretty intuitive if you think about it. That basically there's 2 steps. Find the appraised value and the percentage that the category is of that appraised value, and then take that percentage and multiply it times the actual value. Okay, so that gets us to where we need to be as far as dividing these up into different categories so that the ones that are depreciated can be depreciated and the ones that are not are not. So now we get to answer the question, what really is depreciation? If it doesn't mean what you guys thought it meant in terms of your day-to-day use of the word, if we don't mean just that it's going down in value, what do we mean? Well, the key word to accounting depreciation is this word right here, allocation. Okay? So with accounting depreciation, all we're doing is taking one really big cost, the cost of whatever asset we're talking about. So this is bigger than a normal expense. So we're taking a really big cost and we're dividing that cost into the time periods that it will provide value to us. This is us using a fictional concept, which is depreciation, to divide up one really big expense over multiple time periods to follow the matching principle. If you remember the matching principle, what does that mean? It's the underlying concept behind GAAP-based accounting, and it just means that whenever we recognize revenue, so whatever time period we recognize revenue in, whatever costs or expenses we had to pay to earn that revenue, those expenses should be recognized in the same time period as the revenue that they help us earn. So if I pay $500 in rent for a factory or whatever, that $500 should be in the same time period as the revenue that I earned from using that factory over that time period. That's the matching principle, right? So, with depreciation, anytime I buy something that will last more than this year, okay, let's say I buy an asset that will last 20 years. That means the cost of that asset, if I want to follow the matching principle, should be divided over the number of years it helps me to earn revenue, or 20 years. Okay? Without depreciation, we would just, the year that we bought the item, even though it would help us earn money for 20 years, the year that we bought the item, we would call that an expense that same year. So let me give you an example. Let's say that I have a piece of factory equipment that costs $500,000. Okay? And I say I have a shoe factory. So I have this $500,000 piece of equipment. Say my old one broke and I needed to go out today and buy this new piece of equipment. And I expect this to last for 20 years. So for 20 years, it will be earning me money. It will be used to earn revenue in my shoe manufacturing business. And let's say typically year to year, I'm earning in net income about $500,000. So $500,000 a year in net income. Without depreciation, the year that I go out and buy this new asset, the full $500,000 expense would be recognized that year. So this year, I go out and I buy this asset, and I normally would have had $500,000 in net income, but since I bought this asset, I have $0 in net income this year. So anyone that looks at my financial statement would look at my income statement and say, this person or this entity broke even or lost money this year because there's no net income. Okay? They're not seeing necessarily why that is, but they're just seeing that there's no net income. Then next year, when I go to do my financial statements, you would see $500,000 plus of net income. So you would see the $500,000 that I normally earn, plus whatever amount that I would have normally had to spend as an expense for this piece of factory equipment. I don't have to spend that this year. I don't have to expense or recognize that this year because the full amount of that was recognized in year one. So basically, from a matching principle standpoint, you have this big cost in year one that should go for the next 20 years, should be matched against revenue that it's helping earn. But instead, in year one, you have the full amount there. So we have year one that the income statement is very much understated because I recognized essentially close to $500,000 worth of expense that should have been recognized over the subsequent 19 years. Okay? So what depreciation does is it allows us to take a big number, a big expense, and divide up and assign a portion of that expense to each year that it helps us to earn money. That's all depreciation does. Divide one big cost into the multiple years that it allows us to earn money. And the way that it does that, you have heard me say many times the word recognize expense. Every time I say that, what that means is there's a journal entry done where one of the components is an expense account. And that means whenever I put money into an expense account, that means that my income statement for that year, which again, remember, is just revenue minus expense. So my income statement for that year will be, my net income will be lowered by however much additional expense I recognize that year. So ideally, assuming that I plan to use this piece of factory equipment equally over the next 20 years, I want to divide its cost equally over that 20-year period so that on my income statement, each year I'm recognizing 1/20th of that expense. Okay? So dividing that big expense into multiple time periods and allocating it systematically to the different time periods that it will help me use, that's what depreciation is. Okay? So when we go on talking about this, basically for the rest of your discussion of accounting, however long that is, we will talk from now on about two concepts. We'll talk about market value and we'll talk about book value. Okay? And those two concepts are related to how you used to understand depreciation based on its actual market value, and then how you should understand depreciation now, which is book value. Okay? So, let's do the clarification. All right. So, in the next slides, we're going to talk about three different ways of doing depreciation, three different methods. Okay? These different methods will help us determine how much depreciation to recognize each year. That's all that those do. That's the only way that they're different. How much do we recognize each year? Whichever method we use, the journal entry will look like this. Got a debit to depreciation expense and a credit to accumulated depreciation. Okay, so no matter which method of depreciation we talk about, and the three methods that we'll talk about are straight line, units of production, and double declining balance, those three methods will get me a number. Okay, depending on which method I use, I will get however much depreciation I need to recognize each year. Once I have that number, I just plug it into this journal entry. Okay? No matter what it is I'm depreciating, the journal entry will always look like that. The only part of it that sometimes is slightly different is you may have like a dash at the end of this that says like machinery, or some description of what asset class we're talking about as far as accumulated depreciation goes. But when you see the word book value, okay, all that means is initial cost. Remember all those bubbles that went into the asset class, the fees, the delivery, all of that stuff that went into the initial cost, minus accumulated depreciation. Okay? So as we go year to year doing these journal entries that cause depreciation expense to be recognized, we will, each one of those journal entries, the credit side is accumulated depreciation. That basically is saying, here, keep track of how much you've already allocated from your initial cost. So, got my initial cost. Then as I go doing depreciation year by year, each time I do a depreciation journal entry, I'm adding to this accumulated depreciation. Okay? So my book value is whatever the initial cost was minus what my total accumulated depreciation to date for that asset is. Okay? So book value just means how much left of that initial cost do I have still to turn into an expense? How much do I still need to allocate over the next however many years? Okay? That's book value. Okay? Oftentimes, since both market value and book value both go down as time passes, a lot of people in their mind kind of flip-flop or view these as the same thing. They're not. Okay? Book value doesn't have to have anything at all to do with market value. Book value only is related to how much did you buy this asset for initially, and of that initial cost, how much of that has already been recognized as an expense. Okay? But when we get rid of stuff, assets, plant, equipment, etc., if you sell an asset for $10,000, you would look at your book value and you'd say, okay, how much of the initial cost did I still need to allocate as an expense? What is its book value? Okay? Whatever amount that is, that's the amount of my money I'm getting back when I sell it. Anything more than that would be a gain. Anything less than that would be a loss. So book value is what tells you in the future when you get rid of assets, whether you got rid of them at a gain or at a loss, or you sold them or got rid of them at at their actual value. Okay. So from here on out, if I say book value, you should immediately think, okay, he's talking about depreciation, and he's just saying this is the amount that has yet to be recognized through depreciation. Okay, so before the numbers go into accumulated depreciation, when you buy the asset, go back to those slides I already showed you where you have a debit to either buildings, land improvements, property, plant, equipment, whatever your asset class is called. You have a debit to that initially to record the initial cost. That is just changing one asset for another, right? It doesn't become an expense until time passes, and at the end of a year, you do a journal entry that recognizes the amount of depreciation for that year. That means whatever that amount is, that's the amount of expense related to this item that you're recognizing. Anybody have questions on that? Okay, so once we know what depreciation is, then we have to actually calculate it. So the three things we need to calculate depreciation are initial cost, so everything that's required to get the asset to its usable condition. How much will it be worth when I'm done using it? So maybe it has scrap metal value, maybe I'm going to be able to sell this to someone else who's going to fix it up. Whatever the case may be, I'm going to estimate when I buy an asset whether I think when I'm done with it, it will still have value to someone else, and if so, how much value is that? And then finally, how long will I be able to use this asset? Or how long will it provide value to me? And this could be measured in years. It could be measured in, like if you're talking about vehicles, it could be measured in miles driven. It could be measured in machine hours. Any way that you have of measuring how long something will be valuable to you. So, like I said, there's three different main methods that we use. But what you'll notice about all of them is the only difference in these methods is when we're recognizing what portion of the cost. Okay? So no matter which method you use, you're still, once you're done with depreciation, you should have recognized all of your initial cost minus whatever your salvage value is. That gives you depreciable cost, and all three of these methods will use up all of your depreciable cost as long as you keep the asset that way. The question is, when will you recognize these expenses? Okay, so depending on which of these three categories you choose to use, businesses can make that choice. Typically, once you make the choice, you're stuck with that method. You can change later on down the road. It's kind of a pain in the butt. But no matter which one you choose, you still are going to allocate all of your costs. It's just a matter of which period to allocate them in. Okay? So straight line just means count how many years you're going to use the asset and divide the depreciable cost equally over those years. Whenever I say depreciable cost, that just means initial cost minus salvage value. Okay? So in this case, that's $9,000. That's my depreciable cost. I will divide that equally into 5 years, and that means that each year I will recognize $1,800 of depreciation expense. So in actual terms, or in actual English, what does that mean? It means that initially I traded one asset for another, apples for oranges, gold for silver, whatever the case may be. So as of that initial trade, they were the same value, right? But as time passes, I'm using up the value that this asset has for me. And I'm saying that I will use that up at a rate of essentially 20% per year. As I use up the value, that asset turns from, or it goes from being an asset to being an expense. And that's essentially what we're doing right here. This is taking away some of the value of that asset on our balance sheet. That's what the accumulated depreciation side does. And the depreciation expense side recognizes this as an expense. So with this graph, you see that each year the amount of expense we recognize with straight line depreciation stays the same. Okay, this is called amortization, or dividing with equal payments over a time period. But the balance, or our book value, you see that will go down and kind of goes down in a straight line sloped depreciation. Okay, because we're taking a little bit, that same amount of the value off each year until we're done. Okay. So if you looked at the balance sheet for this particular asset, for machinery, assuming we have 2 years that have gone by already, you would see machinery listed at its initial cost. You would also see another line item below it called accumulated depreciation, where it said less accumulated depreciation, and then out to the side you would see the book value. Okay, so if I went off and sold this machinery for $6,500 tomorrow, that would mean I had a $100 gain on the sale of that machinery. Because my book value is $6,400, and then anything above or below that would result in a gain or a loss. So if I looked at a depreciation schedule for straight line, which again is basically just a spreadsheet that has it all listed out, you can see that the expense amount doesn't change year to year, and the percent of the total doesn't change year to year that I'm taking off. So each year I will remove or allocate 20% of this asset into expense. Okay, and then once I'm done, $9,000 will be allocated as an expense, but I still have an asset worth $1,000 on my books that I will either sell or in some other way get rid of. But until I get rid of it, it would just sit on my books as something, an asset that I have that's worth $1,000, similar to if I had $1,000 in my cash account. Okay. All right, so that's straight line. The next way of looking at this is units of production. Okay, so in this method, instead of saying how long do we expect this product or this asset to provide value to us in terms of years, we're now going to look at it in terms of activity. So if it's a machine, we may say how many machine hours will this machine provide to us? Or in other words, how long can I run this machine before it dies? If I know I have 1,000, or let's say I have 10,000 hours on this machine before it dies, then I will say, okay, same as before, I take my cost minus my salvage value, and that gives me the amount that I need to depreciate. And instead of dividing 9,000 by 5 years, now I would take it and I would say I'm going to divide 9,000 by the number of hours that this asset would be valuable to me. Or in my example, let's say 10,000 hours. So you'd have $9,000 divided by 10,000 hours, and that would give you a cost per hour of depreciation. So at the end of the year, you would say, okay, how many hours did I run my equipment? That's this part. Number of units produced. In this case, that would be number of hours used. You would have number of hours I ran my equipment times the rate that I figured out up here, and that would give me what the amount that needed to go into my my depreciation journal entry was. Okay, so this will give me less of a uniform look at year to year what the amount's going to be. That went by a little too fast here. Hold on. So we got cost per unit, and then once we figured out the 25 cents per unit, we multiplied the 25 cents per unit times the actual number of units produced in this period, because the activity base that we used in this example was number of units produced by this machine. we equally could have used, instead of number of units produced, we could have used number of hours ran or any other type of way of measuring activity. Right? But whatever type of activity we use, we still have the same way of going about figuring out the cost per unit of use. And then we take that each year, the number of units that we produced or the number of hours we use this machinery will likely fluctuate. It will go up and down. So until that full $9,000 worth of depreciable expense or cost is used up, each year we will look and say, okay, this year we had 7,000 multiplied times 25 cents. Next year, if we have 10,000 times 25 cents, we will keep doing that each year until we've used up all $9,000 of depreciable cost. Okay? So we're not guaranteed that this will happen given during any particular time span. We just know that eventually we will use this enough that we will use up all of our depreciable cost. Final method we're going to look at is called the double declining balance method. It's the most complicated looking method, but it's actually really not that bad either. Okay? In this method only, we're going to ignore salvage value for a minute. Okay? So the first step is to pretend like we're calculating straight line without salvage value. So we assume the salvage value is 0. We look at how many years this asset will be valuable to us. And however many years that is, put a 1 on top of that number, and that gives you your ratio. So if I said this is 5 years, put a 1 on top of that 5, and 1/5 is equal to 20%. Okay? So step 1, pretend like we're doing straight line. Don't think of a salvage value, and just figure out what percentage, if we were using straight line, what percentage we would allocate each year. So if it's 5 years, that's 20%. If it's 10 years, that's 10%. If it's 20 years, that's 5%, right? Basically, however many years, 100 divided by however many years we're talking, and that will give you the percentage that you need. Okay? So in this case, we said 5 years, that's 20% per year. Okay, that's step 1. Step 2 is, whatever this rate is, double it. Hence the word double declining balance. So instead of 20%, the straight line rate, we're going to use double that rate, or 40%. Okay, what does that mean? That means in year 1, we will take that 40% and we will multiply it times the initial cost. Again, we're still ignoring salvage value for now. Okay? So 40% times the amount of that initial cost, which is beginning period book value, and that gives us $4,000 that we would recognize in year 1. Okay? So in year 2, we still are going to multiply book value times 40%, but now instead of a book value of $10,000, which is our initial book value, we have that minus what we already recognized here in depreciation expense. So for next year, our new book value is $10,000 minus $4,000, so $6,000, and we multiply that times 40% to get our depreciation for year 2. Keeping in mind that at the end of the day, the total of this category will be 9,000. So eventually, where you see this asterisk, okay, 1,296 times 40%, what is that? Someone with a calculator do that real quick. What's 1,296 times 0.4? Well, we don't even need to calculate that at this point. Okay. Basically, we're going to keep a running total here, year by year, of how much we've depreciated. So after year 1, it's 4,000. After year 2, it's 6,400. After year 3, what is that? 7,840. Okay, and on until we get to 9,000. So in this last year, Okay, regardless of what 1296 times 40% is, that's going to be some number greater than what we have left. Okay, so at this point, all we're left with is whatever the difference is in what the total amount of depreciation we've recognized and what we're able to recognize. And long story short, whatever your depreciable cost is, no matter which method you use, again, depreciable cost is just initial cost minus salvage value. Whatever that depreciable cost is, that's your cap max that you can recognize in depreciation. So no matter which method you use, once you hit 9,000, you're done with depreciation. So under this method, you would just go on multiplying times book value times 40% until the last year when whatever that number is puts you above $9,000, you would just end it at that $9,000 amount. So for this example, let's say 1296 times 40% is $500. I know that's not it, but assuming 1296 times 40% is $500, but all we have left to get to 9,000 is this 296. That would mean that is what I put in my last year's depreciation. I know that last type, double declining balance, is somewhat complicated in terms of, you got to move a bunch of numbers around and look at different numbers there. But we really won't talk much more about this after today, declining balance. We'll talk a little bit about units of production. I'll walk through some examples of these on Thursday. But going forward in this class, in principles, we really won't talk about anything other than straight line. Okay? All right. So like I said, if you're comparing the three methods, the main thing to get out of this is that all three will eventually allocate all $9,000, no matter which one you choose. The way that they vary is which year gets which amount, right? Under the straight line method, it's all uniform. Each year we get the same amount. Under double declining balance, it's very heavily front weighted, right? So we're going to recognize depreciation much more heavily towards the front end of this asset. So the first couple years we got 4,000, we got 2,400 recognized. The last 2 years we got 864 and 296. So obviously very heavily weighted towards the front end. Okay? So why would you choose one or the other of these methods? Well, most businesses will choose the one that most closely mirrors real market value. Okay? Because like you guys, most people when they think of depreciation, they think of an actual loss in real value. And having your book value mirror market value will be, closest to what is really going on. Okay? So most companies will look at, whatever they're doing. And incidentally, you don't necessarily have to choose one of these methods for all of your assets. Some companies will choose units of production for some of their assets, straight lines for other assets. Okay? To further complicate the discussion of this, when we start talking about taxes, the United States tax code actually has different ways of doing depreciation that it makes you do. So most businesses, even if they only choose one of these three methods for doing their financial books, they may still have to calculate depreciation differently for the purposes of doing their taxes. Okay? So this is a complicated subject. When we talk about partial year depreciation, a couple of notes. Obviously, most companies are not going to buy and sell assets only on January 1st to December 31st. So almost always, when you calculate depreciation, the methods that I talked about, those will give you a year's worth of depreciation. Well, what if I bought the asset on October 1st, and my business works on a calendar year, fiscal year? That means that I will only have that asset for 1 quarter of the year, which means for that first year, if I look at 1 quarter of 1 year, I use whichever calculation I want to get my yearly depreciation, but then I take my yearly depreciation and only recognize 1/4 of that if I bought the asset with only 1/4 of the year remaining. Like I said, two components that we need to know to be able to calculate depreciation, salvage value and useful life, are both estimates, right? And one of the key characteristics of an estimate is that they're a guess, right? They're wrong most of the time. So, if they're only wrong a little bit, in accounting we have this term called materiality, where we're not going to mess with it if we were only off by a little bit. So think, if I thought salvage value was going to be $1,000 and it's actually $900, that's not that big of a deal. And so we probably wouldn't mess with changing our depreciation estimates based on that. Well, what if, say, we expected our asset to have, let's say it's a $1 million asset that we expected to have $200,000 salvage value, but we later determined that it will have no salvage value. Well, in terms of overall numbers, $200,000 to just kind of have sitting out there, that's a pretty big number. And so that would be considered probably material for most businesses. And so when you run into an estimate that was wrong by that much to where it's material and it's making a difference to the company, then you have to go in and make changes to estimates made. The way that you do that is essentially, we're basically going back through and, too far. And instead of taking the initial cost minus salvage value divided by useful life to get my depreciation, I would then, when recalculating it, instead of using the initial cost, I'll just look at what my remaining book value is. That's the amount that I haven't allocated yet. And from that, I will subtract out whatever the new salvage value is. So if it used to be $20,000 and now it's 0, I would put 0 in there. And then if my useful life changed, I will change that too. And so this new calculation takes the amount that I still have left to allocate and just reassigns that over a 4-year period instead of the remaining 2 years that would have been in my initial estimate. So anytime that you have an estimate that needs to be changed, you would go through this calculation and just use the book value instead of initial cost, and revised salvage value, revised useful life instead of the initial estimates. We already talked about how that looks on the balance sheet. A couple more considerations that I want to. Well, actually, I'm going to finish right here for today because I'm about to die on my computer, and I'm recording this, so I want to make sure that it's safe. So we'll pick up with this on Thursday. I've got probably 5 more slides on this, and then I'll walk through some problems on Thursday. Okay, any questions before I stop? All right, go from there on Thursday.